second largest tick ever in my Tradestation tick database. $tick represents the number of advancers minus decliners on any given basis. We track this on 1-minute charts as well for some of our trading systems. And you'll see today, here is the NYSE tick. Opening high is 1994. That means there are 1,994 stocks that are ticking up, minus those that are ticking down. There's about 3,700 stocks on the NYSE, and you see that this is the second highest tick reading and the highest tick in over 21 years. And what you see in general in this as well, this is the monthly chart, is a divergence of the NYSE tick as it expands between higher highs and lower lows, and we see more and more volatility in the markets. What happened on this day? Alan Greenspan had a surprise rate cut, and you can see that in the S&P. This is on January the 3rd, 2001, over 21 years ago, closing in on 22 years ago. The market was selling off, and I remember this vividly, just an unbelievable rally in the S&P. The index values were much lower, but it went from 1210 all the way up to 1280, 70 points then on that index value would be equivalent to about the S&P's at 3,600, so 3 times as much. It'd be about 210-point move in the S&P would be equivalent. So interesting that we had this massive tick higher. What does the market do? Oversold, overbought. I want to talk about that as well. Let's look at the market internals. So today, you would think that would be an overbought scenario. What does the market do? Initially, it rallies, and now it may roll over eventually, but the initial reaction to overbought and gap ups when the market has a bullish bias is up. What happens if we get a negative tick to the same magnitude of that? You see open is 1973, high is 1994. Let's scroll back a few days because this just happened a few days ago. And while we saw one of the lowest tick readings in the afternoon a few days ago, and then at the open on the day of the CPI. So I'm going to scroll back to that. So here is Thursday. Just last Thursday we had CPI in the pre-market. An hour before the open, the market gapped down. It sold off viciously in the pre-market. This is the day session only data. What do you see here? The tick reading of minus 1971. What is the immediate reaction? A more immediate response to an oversold is up. So when you're overbought today, the market initially goes up. When you're oversold, I mean, there's a little bit of wiggle, and it goes down and takes out these lows, but in a tight range. But in say the first 30 minutes, the initial reaction is up, and then it goes higher because it's oversold. Now, on a day like today, you don't get such an immediate reaction to the downside. You see the initial reaction over the first 30 minutes is up. And so we may eventually get this rollover price action in this market because that is extremely overbought. And if you look at what's going on here on the monthly chart, it's interesting to see that we've had divergence longer term. This is going back to, I guess, 1995 or so. Longer term, there's a divergence here, but even more so, it's kind of the same here, and then it expands since the pandemic. We have more and more volatility in the tick. As the index prices get larger, this tick seems to be whipped around in greater values between higher highs and lower lows on the NYSE. So studying the tick a lot, looking at these overbought, oversold scenarios, highest tick reading since Alan Greenspan cut interest rates, surprise interest rate cuts on January the 3rd, 2001. We also talked about, let's take a look a little bit deeper, a deeper dive. That's the main thing I want to share with you. I want to do a little bit deeper dive here on this. So you saw the low tick reading on Thursday. So we're going to go back to Thursday, and then we're going to look at Tuesday afternoon as well. And so here is Thursday when you get the gap down, and then on Tuesday afternoon, scrolling back to Tuesday afternoon, you see minus 1500 reading. Now, we hadn't had that since the January the 26th. So it's a very low price action, minus 1500 area in the afternoon. So just look at the afternoon ticks, not the full day's ticks. We hadn't seen that since January the 26th. Sometimes you get bigger divergences right at the open, but in the afternoon you hadn't seen a minus 1500. And then 2 days later we get a minus 1800. So minus 1500, minus 1800, oversold, market rallies, and then what you see again, and in the opposite direction, is on Friday you get plus 1200, plus 1238, and was that the high on the day? I believe so. Then the market sold off to the closing prices of the Tuesday, Thursday, and it gapped up. And it gapped up hard and hit this highest tick reading in 21 years. So kind of a plus 1200, then plus 1900 was preceded by a minus 1500 and a minus 1800 at the open. So really swinging between overbought and oversold. Volatility like this can be a bearish indicator. Markets get very volatile around trend changes, and so we've talked about how we've been in a bull market, then we've been in a repricing, and then gradually, and then suddenly, then a bear market. But it could be, I could be wrong. The trend change could indicate either a strong bull market or a strong bear market, because the trend we've been in is neither a strong bull market or a strong bear market, but what I consider repricing. So this volatility could indicate a trend change to either a strong bull or a strong bear, which I'm in favor of strong trends either direction as a short-term trader. And so this repricing action has been a little more challenging the last month or two. So looking forward to a strong trend in either direction, and these could be indicators of that strong trend coming. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.